And we are live.
Oh, hello. Welcome to Real Estate After Dark, where the market never sleeps and neither do we. Your late night source for insight and answers to your real estate questions. Tonight who do we have, Adam?
We have Randy Hardison with Foundation
Title
Title and Escrow. He's going to talk to us about 1031 exchanges.
1031. 2 weeks y'all been waiting on this show.
So
Randy, you want to tell us a little bit about your background?
I can.
Can you hear us?
Yes, I can. Can you hear me?
I hear you, yes.
Okay. I've been with Foundation for about 8 years now. And my day job is I handle all the commercial transactions for the company. We're 20 plus offices in 10 states. Our home is here in Franklin, Tennessee. I started out many, many years ago as a tax lawyer and evolved into real estate and commercial transactions. And obviously, when you do mostly commercial transactions, you're always concerned about the tax consequences. And so 1031 exchanges and commercial transactions have always gone hand in hand.
Yeah.
We used to run our own exchange company through Foundation. We have now partnered with two other companies. I still deal with them regularly, but we've partnered with both First American Exchange Company and Asset Preservation Trust that assist facilitate the exchanges, and that's what we're going to talk about tonight.
I know what it is.
Nice.
Can you still hear us, Randy?
I can. You're
Okay.
not moving.
Well, we are for some reason. I don't know why, but as long as you can hear us, that's good.
Yeah.
I can. You're frozen, but I can hear you.
Okay, good deal. All right. So, yeah, everybody, I think 1031s is one of the biggest questions that I get, of course, mostly from investor clients. And I know anytime I get that question, the first person I tell them to call is you, because you've been the most knowledgeable that I've met. You've been honest. I've even come to you myself about possibly doing a 1031. And when it's not a good time, you tell people it's not a good time. So that sticks out to me. But what type of properties qualify for a 1031? Or I guess you could start off by explaining what a 1031 is.
Yeah, and I think backing up even a little more, talking about what capital gains are, as we all know, the IRS taxes all income from every source, whether it's coming from your employer, your employment, or gains from the dealing in property. So whenever you've got property and you're buying and selling, hopefully you're making money off of it. Well, that's taxable, and it's if the asset you're selling you've owned less than a year, it's short-term capital gains. It's taxed just like all the other money you make. If you've held it for more than a year, it's long-term capital gains, and you get a cap on your rate. It kind of reminds me of I think it's the H&R Block commercial where this woman's fretting, and she says, "I have to report the money we made from the yard sale," and everybody kind of laughs and just assumes, well, no, well, actually, yes, if it's taxable. But it's a great illustration of how capital gains work. The reason you normally don't have to pay tax on it is because you're typically selling it at a loss.
Mm-hmm.
But if you were selling it at a gain, it would be taxable. It's capital gains. Same thing with the investment properties that we're talking about. And that's what we're dealing with, business and investment properties, which is pretty much everything.
Yeah.
That definition has evolved over the years. It used to have to be like kind, and as in almost identical. The easiest way I have explaining of what what kind of property qualifies is to tell you what doesn't.
Mm-hmm.
Your principal residence does.
Okay.
Vacation homes kind of sort of do, sort of don't, and we can talk about that later. And most importantly, since 2019, only real estate, not personal property. And there's certain situations where that comes into play, where the property is owned by an entity, and
Mm-hmm.
discuss that too. But it's any property that you bought that you're hoping to make money off of when you sell it.
Yeah.
All right. What is going on? Can you still hear us, Randy?
I can hear you, but I can't see you.
Yeah.
Yeah, I don't know what we've got going on. We're trying to get.
So now we just have a black screen.
I
Yeah.
see that.
This is because this was a good night, Randy.
I know.
This was
Well,
gonna be a great show.
it has been for me. Maybe not on
Yeah,
y'all's
they
end.
They can still see you, which is good.
Technical difficulties.
Yeah.
Yeah, it's a story of our life.
I
With this
know.
show, seems like.
I don't know why we can't.
Well,
He can. So okay, they can at least hear us. They can't see us.
no, so they can hear us. All right.
Yeah, I don't know what's going on.
All right. So you do the 1031s on properties that you hope to make money off of, and mostly investments. And I know that, right before we started, I asked you about, say if a parent were to buy a house and 1031 it for their kids to stay in, and then they ended up not liking the house because it was in an area that was very rural. They come from California, so they were not used to the rural aspect. So they wanted to sell that to buy another house. And they just had to do another 1031, but they kind of would have rather not and just be out from under the 1031. Is there a better way to have done that or to do that?
Well, I think the first thing you have to remember, Crystal, we've talked about this before. This is not tax free. It's all you're doing is kicking the can down the road. You're deferring it. And which means, if you dot all your I's, cross your T's, you've bought some other property, rolled the money into it, you've just deferred it to a later date.
Mm-hmm.
But that also means if you do a 1031, you have to keep doing the 1031. Because if you ever stop or pull it out, you got to pay all the taxes, not only on that last piece of property, but all the taxes you didn't pay.
Yeah.
And so you really never want to do that. It's just part of your real estate portfolio. If you own it for life. And the great thing about it, if you do that and then let your family inherit it, all the capital gains go away, because you get this thing called the step up in basis, and they get to start all over again.
Mm-hmm.
And Crystal, we've talked about this, done this before. It doesn't solve all problems. I have tried to and talked people out of doing them before, because I just didn't think it was part of the long-term strategy. And that could be sort of the case here, that before they try to roll it over in another exchange, they might look at what the consequences are, how much tax they'd have to pay. It's very common. I do a ton of investment properties where parents buy properties in like Knoxville, Tuscaloosa. So they, instead of the kids getting tired of it or not liking it, like in your folks' example, and these others, well, the kids term out, they graduate.
Yeah.
And then they either keep it, rent it to someone else, or they sell it, take the money, and go buy something else. But you got to buy another piece of business or investment property.
Yeah.
And the one thing you can't do readily, there's some exceptions to this, you can't mix 1031 property with your personal residence property. Your personal residence has a whole different set of rules. And, there is a possibility of mixing them a little bit. Let's say, for example, you paid $500,000 for a house. The market changed, and now all of a sudden it's in Nashville and it's worth $1.5 million. What the heck? Let's sell it and cash out. Well, on your house, it's a little different. If you're married, filing joint, the first $500,000 is exempt, tax-free. IRS doesn't care what you do with the $500,000. But what do you do about the other $1 million in gain? It's taxable, just like any other capital gain, short-term, long-term. I have helped a few people do a 1031 on the balance. You take it, go buy some rental properties, and it's like, well, that's part of your long-term investment. Well, but what if we want some of that money to buy us another house? Well, refi, it's called a refi after 1031. Just refi the rental properties you bought and let the rent pay that loan off. Take that money, go buy you another house. Because when you receive loan proceeds, that's not taxable. So there are some, they're just a little out of the box, but it's creative ways of using the rules to try to get you where you want. And if you can't get there, then maybe you just pay the tax and go on. Don't change your entire financial strategy to avoid the IRS.
Yeah.
Let's make sure it's part of your overall financial strategy. The proverbial don't let the tail wag the dog. We all like to avoid the IRS, but don't do it at the expense of changing what you're trying to accomplish in life.
Yeah. That makes sense. Let's see. So we've already talked about, does my primary residence or vacation home qualify? Kinda. You touched on it.
Let's talk about the vacation home for a minute. That used to be a great way that people would use 1031 exchanges, and it was so great. The IRS kind of snapped back on it. And now there's a whole new set of rules that says that to prove that it's true business or investment property, you have to rent it out. You can't be the only one using it.
Yeah.
And you can use it, but you can't use it more than 10% of the total days that you had it rented out. And there's some other restrictions on it, but vacation home's not a great option anymore, unless you're buying a condo in Florida or somewhere and you're going to put it on the rental pool. But that's not normally what people are wanting to do with a lake house or something.
Yeah. Yeah. No. So say you have a rental in Florida and you want to buy 2 properties. You can do that, correct? Like, say, because it has to be equal to or greater than, right? To exchange into it?
It does. The purchase price of your replacement properties, that property you're buying with the money, has to be equal to or greater than the sales price of what you're selling. There is, and this is fairly recent, a recognition by the IRS of what's called partial exchanges. So it used to be if you sold for $1 million, you had to buy for $1 million. And many situations, it's possible to buy for less than $1 million, and it doesn't break your exchange. It just means you're going to have partial recognition. You'll have to pay some tax proportionate. So if you bought $800,000 with your $1 million, that's 80%. So 80% is tax deferred, 20% would be taxable, which is better than what used to happen. It was all or nothing.
So what does it depend on how much your capital gain is? Like, is it how long you've owned the property or?
Well, it's just, you need to, I always tell everybody to get with their CPA, their tax advisor. Just let's run the numbers and see how much are you saving. Again, if it's a long-term capital gain, you're going to be taxed at approximately 20%. So if your gain's $100,000, you're going to have to pay the IRS $20,000. By doing a 1031, you don't.
Yeah. Until later down the road.
Now, at what point somebody would say, "I'll just pay the IRS and not have to live with all the restrictions of 1031s and rolling it over and over." That's kind of a personal decision. Some people may say, if my tax is under 20, I'm not going to worry about it. Some may say if it's under 200, I'm not going to worry about it. That sort of depends, and that's why you need to get the CPA and tax advisors, because we don't always see I can talk theoretically with folks about an exchange, but I don't know what their financial statements look like. I don't know what their goals, their plans. I don't really need to know that much about them, other than to discuss the types of things they need to be thinking about.
Yeah. Well, Randy, what are some key deadlines for identifying and closing on a replacement property?
Well, and that's one of the toughest parts about all of this, especially in this marketplace. It's a great time to sell property because everything's appreciated so much. But you have to remember the flip side of that coin is it's a terrible time to be buying property. So it's like, oh my God, I paid $500,000 for this, and I'm selling it for $1.5 million. Well, yeah, but you've got to go back out in this marketplace and spend that $1.5 million. And so you have to sort of weigh, is that a good business decision, without regard to the tax consequences? But once you've sold that, what's called the relinquished property, the front end, you have to identify some possible replacement properties. You can close on up to 3 of them. You can actually close on more than that. There are some additional rules and regulations. You have to do some math on it, but you have 45 days to do that identification. And you do that in writing with the qualified intermediary, one of those companies or some other company that we just talked about that's in the business of acting as a qualified intermediary. They're exchange companies. And then of those you've identified, as I said, you buy up to 3 of them without some additional qualifying. But the absolute key is you have to close within 6 months. So
you got 45 days to get everything worked out, am I right?
Yeah, it's kind of helpful to already know what you're going to buy, and you could even have it under contract.
But you got 6 months to close it.
You've got 6 months to spend the money, and there's no extensions. Actually, the IRS has been granting extensions lately because of the weather.
Yeah.
But you can't count on that.
You want to know what's funny? My CPA contacted us via email yesterday after taking my payment on the 1st of April saying, hey, you don't have to pay right now. You can wait until I think October or something. I'm like, well, that's great and dandy, but can you refund my money?
I just filed my return today and I took advantage of that. Thank you very much. They actually issue you vouchers now so that,
But anyway, so I'm like, how did you forget? You literally just took it on the 1st.
Well, and the thing is, you never know when the weather's going to do something like that. You can't count on the extension. And one of the things to remember too, and this catches a lot of people, you have 180 days or the due date of your next return. So if you always have to be careful, if you're selling in November or December, you have 100, so you have 6 months, or April the 15th, whichever occurs first.
Ah,
So you might have less, but there's an easy way to solve that problem. And it's kind of dumb if you think about it. All you have to do is file an extension.
yeah. Huh.
And then you get the full 6 months, but you forget to file the extension, and you, even though you close within 180 days, you just blew up your exchange,
Yeah.
which is not the worst thing that ever happened. What happens if you mess up your exchange? Well, you have to pay tax.
Yeah.
Not the worst thing that ever happened.
Yeah. So, and that's why it's important to have somebody in your corner that knows all this stuff. So whenever you go through the process of the 1031, you have you to remind you of all these timelines, and kind of like us in real estate, you know, walking through a contract with somebody.
Oh,
They're
yeah.
not going to keep up with when earnest money's due, when the inspections due, you know, all these things. So
Yeah, that's kind of like on commercial transactions. You have the whole assortment of due dates, their due diligence period, their approval periods. You know, most big companies should be capable of keeping up with that themselves, but we kind of have to follow along and remind them, just like you guys do.
Yeah, and that's I don't think a lot of people realize that, you know, there's so much deadlines that and timelines that we have to keep track of. And you know, they think it's just okay, you know, Crystal, yeah, I'm gonna buy your house, you know, here's what I'm gonna pay you, and you know, that's all it is. And then you just 30 days you just show up for a closing. There's so much that goes into stuff.
And it would be easy enough if you just did one deal at a time, but I'm pretty sure I don't, and you don't do one deal at a time. I think as of this morning, I'm working on 162 open files.
well, no wonder you're 12 hours a day.
Well, unfortunately, with technology, it is so much easier to keep track of these things than it used to be. But but y'all have to deal with it just like we have to deal with it. And that's what they rely on us on.
Technology works.
Until it doesn't.
Right. That's why they can see you and they can't see us.
But that's okay.
I understand. It's like I tell people will ask, and I ran through it today. You know, they've sold a piece of property. Well, we're going to wire you the money. Will I get it today? Probably. If the internet doesn't go down at my bank, your bank, the Federal Reserve Bank, we don't lose power. I mean, Murphy's Law kicks in. Can't guarantee anything.
No,
and I think we've had our run on technology on doing this show, so we just kind of do it.
Yeah. Now you said sometimes during certain circumstances you can miss a deadline or you can extend.
It's very rare. You shouldn't depend on that, obviously.
Yeah.
But yeah, you've got your 45 and your 180-day deadlines. And, you know, and again, what's the worst thing? You're getting close to you identified some properties, you're getting close, you know, near the end of the 180 days, but there's some issues, inspection issues and other things. Don't buy a piece of property that's got problems. Just let it expire. What's the worst that happens? We give you your money. You do whatever you want to with it, including you pay the tax.
Pay your taxes. Yeah.
You pay the tax. It's just a tax deferral. And if we can't complete everything, you don't defer it. You have to pay the tax. And that's not always the worst thing in the world.
Yeah. Sometimes things happen for a reason.
They do.
I'm a believer in that.
Yeah.
They do.
So
we've went over most of those at the bottom there.
All right.
See, what role does a qualified your
intermediary?
Yeah, your role during the 1031 is called a what?
The qualified intermediary, and one of the reasons we got out of the business because we needed 1031s on so many of the transactions we were handling, and you can't really be the closing attorney, or at least arguably, you can't be the closing attorney, settlement agent, and the 1031 company. It's a gray area.
Yeah.
So that's why we partnered with the two exchange companies that I mentioned. Plus, it's tedious paperwork, and I don't like doing it. So they take care of all that. They keep track of the deadlines on the exchange. They'll notify, they'll follow up, and it's been a good partnership for us. They've got much better software to do that on.
And then they get to use all your knowledge.
Well, we work together. And as a matter of fact, one of the companies, Asset Preservation, and both companies have local people. They're nationwide, but Asset Preservation has the local attorney named Susan Eschenberg. I'll give her a shout out. Who I really love working with because she used to work for me and I trained her. However, she has learned a lot above and beyond since going to work in the exchange. They're outside exchange business, but there's a lot of exchange companies. The only thing I would caution people is to do your due diligence because exchange companies are virtually unregulated. So you're talking about a company that's going to be holding hundreds of thousands of dollars of your money, maybe millions. Do you even know who they are?
Yeah.
There have been some bankruptcies by exchange companies in the past.
Oh, wow.
Oh, and just sent letters out to everyone that said, "Oh, we were holding $350 million of people's money for exchanges. We lost it. Sorry, we're in bankruptcy. Have a nice day."
You're sick.
Check your exchange company out. I like the ones that are part of large financial organizations like First American and Asset Preservation, which is part of Stewart Title and Stewart Financial. It's as safe as it's going to get. And there's a lot of them out there. But the one thing you've got to remember, in order for this to qualify, you have to do it the way the IRS says. It doesn't matter whether it makes sense or not. And I've seen a lot of people who say, well, I'm not going to go through all that. I'm just going to let my lawyer or title company hold the money and then I'll roll it over. Well, there is no such thing. You just blew up a possible 1031 and you're going to have to pay tax. You have to sign an agreement. You have to use an exchange company or it doesn't work.
Okay.
Common sense would say, well, what's the difference? Well, if I don't tell you anything that you didn't already know, the IRS is not about common sense. Do not try to use common sense with the IRS or the Internal Revenue Code. It will just get you into trouble. And so, and I've had people call me that says, I want to do a 1031 exchange. Well, okay, let's talk about it. What are you selling? When are you closing? Well, I closed last week. Well, it's too late. It's too late. The horse is out of the barn. It's too late. It can't be fixed. Well, I don't have the money. The title company is still holding it. It doesn't matter. The IRS calls that constructive receipt. You could have it. Therefore, you do have it.
I gotcha.
You're going to have to pay the tax. It's over. Sometimes in this area, you got to have a plan. You have to think about it in advance. Or else you can't pass go. You can't collect $200. That's just not the way the code works.
Good question. Can I use my own attorney? So you said no, you cannot.
Well,
I
I see people do that all the time. The problem is the definition and the regulations say that it has to be a qualified intermediary, and it specifically says it cannot be your personal attorney.
Oh, wow. Okay.
They are disqualified. It's supposed to be somebody independent. that holds the money in escrow.
Kind of somebody that has no leg in the race.
That's true, because otherwise, if it's your own attorney, we fall back into that constructive receipt. Well, it's your attorney, so it's the same as it's your money.
Yeah.
They're not independent with a signed agreement that says we're going to hold this and we're not going to let you have it until you do this, this, and this. And so I see people do that a lot, and it if the IRS never checks, if you never get audited, I guess that's okay. But I don't like fooling with the IRS.
No.
It's not worth it. And the fees that the exchange companies charge is not astronomical. You may be talking $1,500 for the entire thing, possibly $2,000 max for typical exchange, compared to the money that you're saving in taxes. Just a little extra, just to make sure you dotted your I's and crossed your T's. Because if it were me, just the way my luck goes, I'd be one of those that gets audited. And then, once they find a questionable 1031 exchange, then they're going to open your audit up and look at everything, because they'll assume that, well, if you did that on this deal, what else have you been doing?
Yeah.
You never want to go down that rabbit hole. Never.
No. So this is like a financing and ownership question. Can I get a mortgage on the replacement property? Well,
we kind of alluded to that. Yeah, that's called a refi after.
Oh, yeah.
And
okay.
you most certainly can.
Okay.
And the one thing too to remember, at least when you're calculating how much capital gain you have, debt doesn't factor into it. So you pay $200,000 for a house. You're going to sell it for $500,000. Well, you got $300,000 worth of gain. You roll it over into something else. If you don't, you're going to owe about $60,000 to the IRS. But what if you have a $200,000 loan on that? Well, see, there's no line item on your capital gains form for debt. So all of a sudden you owe $60,000, but you got $300,000 minus the $200,000. You only got $100,000 at closing, and you owe $60,000 to the IRS. So you just sold your $200,000 house for $500,000, but you're only putting $40,000 in your pocket. Great time to use a 1031.
Yeah.
Okay.
And you have to roll that debt over. Your replacement property is supposed to be equal to or greater than the sales price of your relinquished property. Well, you're supposed to have just as much debt in the new property too, or you get into the partial exchange. That's why you need a good CPA to run the numbers.
Yeah.
Especially one that already knows what your financial situation is, what you did last year. You need everybody to pull the picture together.
Yeah. So what about a reverse 1031?
Number one, it's more expensive, but that's the situation where you found a piece of property. You really, really want to buy this property. You have some other property that you need to sell or that you want to sell and put that money into this, but you've got to close now on the one you're buying, and the other's not going to close for 3 or 4 months. You can actually do that. The exchange company buys the first property for you, and they hold the title in escrow instead of your money. They actually pay for it for you. Where do they get the money from? You. And that's the difficulty about a reverse exchange. You got to have access to some money, either through a loan or out of pocket, to buy this first property. And then once the other one sells, then you take that money to pay that back. It's hard to find banks that are savvy enough that understand that, but you can buy first, sell later.
Yeah.
And the whole thing has to be done within 180 days. the complexity involved for the exchange company is why it's probably going to cost twice as much in fees to do a reverse exchange. But sometimes the market will dictate you've got to do it that way. And I've seen more reverse exchanges in the last 3 or 4 years than I've seen in the last 10.
Oh, wow.
Wow.
Yeah. It was easy to sell properties. It was hard to find what you wanted to buy. So
Yep.
people would reverse.
What are some of the biggest mistakes that you've seen, like people make doing a 1031 when they probably shouldn't have? Because I'm sure you can tell people you don't recommend it, but they have it in their head that they're going to benefit from it.
Well, I guess part of that and is you're going to have to buy more business property. I had a client that had an enormous windfall of a gain on a piece of property. He was in the business of developing property into smaller tracts, building houses. That's not qualified 1031 property. That's inventory that you hold in the course of doing business when you're selling lots, houses. You can't do 1031s on those. Builders can't do 1031s on lots and houses. It's ordinary income. It's not even capital gains because it's like inventory.
Yeah.
And so if that's what you do and you're really good at it, and that's how you make your money, but you've got this piece of property that you've got this huge gain on, you've got to think long and hard about, do I just pay the tax so that I can use this money to continue doing what I do to make money?
Mm-hmm.
Or do I have to use it and go out and buy some apartments or some rental property or something similar, which doesn't make any sense from a business standpoint. The only thing you've done is deferred the taxes, but it wasn't good business. And I had situation come up in the last year. He still wanted to go ahead and do it because he couldn't stand to pay the IRS. We did it. And then he ended up breaking it because he didn't want to spend the money on what he had to spend the money on because he couldn't find anything qualified that really interested him. But from the investor standpoint, you can sell land, buy duplexes, sell duplexes, buy motels, sell a convenience store, buy land. The only real rule is that it has to be real estate, and the real estate has to be located in the United States. I had a call from some doctor clients last week. They were selling some commercial real estate. He wanted to buy a house in the Bahamas.
Me too.
I said, please do. Pay the tax, buy it, and then I'll come down and use it. But that's not the United States.
Yeah.
Find one in one of our territories or something, like St. Thomas, and then it qualifies.
Yeah.
But so there are a few restrictions. It has to be United States, a state or territory. But I think the other problem I see people is, if they haven't already been looking for property and the opportunity just sprang to sell it for a huge profit, maybe you just need to wait because, again, you've opened the door. You've got 108 days to buy stuff. And so many times they've ended up buying things they probably shouldn't have bought because they were in a hurry to complete the exchange. As I've said several times before, sometimes paying the tax is not the worst thing ever happened. It beats making a poor reinvestment, something that you wouldn't have otherwise bought.
Yeah.
And I guess the best advice is you need to think forward on these things, so that you don't end up having to go find something in a few days. But I've had people sell ranches in Montana and then buy a bunch of dirt leases underneath Dollar General stores, and
Oh wow.
the real estate, the whole definition of like kind, which is what this is all about, like kind real estate, has changed so much. It's real estate equals real estate.
Yeah, no matter how you want it.
Yeah, the best way to define what's not eligible is it's a small list. Vacation homes to some extent, and your personal home. And even those can be mixed and matched a little bit. Let's say you buy a rental house and then you decide to move into it. Well, if you've rented it for 2 years, then you go and live in it for 2 years. You just converted, your 1031 property into 1034 property, and now a whole different set of rules apply if you ever go to sell it. You got the $500,000 exemption. So,
Well, that goes to the question I was actually thinking about. Can you convert a replacement property into a primary residence later?
You can, but you're going to have to be patient because you've got to use and occupy it as your principal residence for 2 out of the next 5 years. So you need to be prepared for about a 5-year commitment in that house to do it. But yes, you can.
You hear that, Andrew? I don't know if you're still on there. He is determined to move to the house in Florida, and maybe that's a way to get around the taxes.
Well, one other topic I was going to bring up, I didn't see it sort of on the notes we were.
Yes.
The alternative to doing a 1031 exchange is doing seller financing. And the reason for that is you've got a whole different section of the code that says if you take your money over time, you can do what's called installment sale reporting. So you sold it this year, but you didn't get all your money. So the only thing you have to pay tax on this year is what you got this year, and the next year, and the next year. And you still have to pay tax on it, but you only pay tax on it as you receive it.
Doesn't hurt as much.
Yeah, no, and it spreads your brackets out, and it doesn't cost us, as much. But the other thing is there's some possibilities of doing seller financing and 1031. You seller finance part of it, you 1031 the rest of it. A lot of these mixing and matching of replacement of principal residences and doing partial exchanges and getting booed out. It used to be, I really need to get about 50,000 of it out. Well, then you're going to blow your exchange. Well, see, you can do that now, but you're going to have to pay tax proportionally on the 50,000. There's a lot of hybrid situations you can do now, like mixing installment sale reporting and 1031s that 10 years ago you couldn't do. And that's another reason I like working with these two very large exchange companies with all these attorneys on staff. They do research all the time because a lot of this stuff changes every year, sometimes less than every year.
I'm saying my head's hurting. All right.
It makes my head hurt. That's the reason I did this deal. I don't have to keep up with it. I just have to listen or read the memos when they send them out.
Yeah. But it's like once you hear it, you don't unhear it.
That's very true. Very true. It's one of those things. It's a very, very useful tool some of the time. But it doesn't cure everything that ails you. And sometimes, I'd say 25% of the time, I talk people out of it because it's just not for them. They're not going to be happy with the restrictions on the backside.
Yeah.
And it's similar to your situation that we started with the folks with they bought the son the house. Maybe they want to go buy a vacation property in Florida. Obviously, we need far more detail to analyze it, but that might be a situation where they just need to pay the tax, and that way they can do whatever they want to with the money.
Yeah.
And it can be a vacation home. There's no restrictions on how much you can use it or not use it. They don't have to keep rolling it over and over and over till they die.
Yeah.
And I meant to come back and revisit that just a little bit. If you've got property your basis is what you paid for it with adjustments. You would think when your kids inherited that would pass over to them. Well, that's not true.
Mm-hmm.
It's what's called the step up in basis that I mentioned before, that when you inherit property, number one, gifted or inherited property is exempt from income tax. The property that you do inherit, tax-free, your basis is not what your mom and dad paid for it. It's the market value on the date of their death. So they could have $1 million worth of appreciation built up in that property that's taxable. They die, you and your brothers and sisters inherit it. Your basis is now $1 million. So if you sell it for $1 million, it's tax free.
That's good to know.
That's good to know. Yeah.
Well, and the one caveat about that, what if mom and dad decide because they want to protect it from nursing homes, creditors, the government? Well, I'll just go ahead and gift it to you now.
Mm-hmm.
No.
Yeah.
If you gift it, it's still not subject to income tax, but you get, this makes no sense, by the way, you get a carryover basis. They have gifted their capital gains to you. If they had just waited and got it by inheritance, you get a step up in basis, and you're talking hundreds of thousands of dollars in taxes that could just disappear. The old saying is that you take your capital gains to your grave with you, and it's really true. And I see a lot of times I'll have people approach me wanting me to do a quit claim. I want to go ahead and gift my property to my kids, etc. It's like, are you sure? I mean, quit claim deed doesn't cost much. Boom, I transfer it into their name. But what about the tax consequences?
Yeah.
And people forget with gifts, there's a carryover basis. So you've done them no favors by gifting it to them
while you're still alive.
Yeah. But and again, I think a lot of people make the mistake of they don't want to hire a CPA. But when you're doing something like a 1031 exchange, you at least for the year you're reporting it, it's worth the money to have a CPA.
So you can use your own CPA.
Do what?
You can use your own CPA as a QI?
Oh, not as a qualified intermediary. That breaches the whole definition of intermediary. That's someone who is independent. You can you can talk to your estate planning attorney. You can talk to your CPA. Your CPA is going to be reporting it. So if you have a CPA and they're the ones going to be preparing your tax returns, I always like for them to sign off and say, okay, I can deal with this. And they usually will know the rest of the story. Or if you're not accustomed to using one, use one this year because you want to make sure that it's tight as a drum, because you're going to have a 1031 exchange on your tax return. You still have to report it. It still shows up on your schedule to your 1040. It's just that once you do the numbers and you qualify for the 1031, the taxable gain is zero. But the IRS still wants to know that you did it. They're still going to check your math. I think it's almost always worthwhile to have a CPA at least do your return the year where the 1031 shows up.
Yeah.
Yeah.
It just and I don't. No offense to H&R Block and TurboTax, etc., but I don't know that their software is the best way to report a 1031.
Yeah,
there's a form. I think it was 8342 that you have to file showing that you had capital gain.
Yeah.
Then you do the whole math, and at the bottom it's zero if you did it right, because you did the 1031. The tax is still there. You just kick the can down the road till later.
Mm-hmm.
And One other thing I think we missed: how long do you have to own the property before you can do a 1031?
Yeah.
That's I have heard answers from tax professionals, CPAs saying, "Oh, it has to be a year," like long-term capital gains. It has to be 2 years, matching some of the other rules. The IRS historically and to this day has never defined a minimum period of time.
Question.
As long as you meet the definition of I bought it for business and investment purposes.
Mm-hmm.
And it was one of the few times that they were actually kind of consumer friendly, recognizing that you may have bought a piece of property intending to hold it for years, and an opportunity came up to sell it that you just couldn't refuse.
Mm-hmm.
The IRS has never defined that holding period to allow you the opportunity to do that. But now you have to be careful if you start selling 5 or 6 a year.
Yeah.
Sell them less than a year, then they're going to say you're a flipper. You're in the business. Not only can you not 1031, we're going to negate the capital gains aspect of all of it and call it ordinary income.
Wow.
So,
Yeah.
Randy, we got a question here.
Yeah.
With the quick claim, the property is gifted to another party. Once the original owner passes away, when does the tax become payable? Does this somehow get reported to
Well,
the IRS?
I'm not sure which tax we're talking about, because for income tax purposes, a gift or inheritance is not taxable. And we have estate and gift taxes, but the minimum, I think, before that tax, the estate and gift tax kick in right now, somewhere in the neighborhood of 16 million. So if it's under that, there's no estate and gift taxation. There's no income taxation. But if you've quit claimed it to them, it's not inherited property anymore. You gifted it. Okay, there's probably no gift tax. There's no income tax. But what happens is the basis that the owner of the property uses to determine capital gains. And if you gift it to someone, you're gifting them your basis, what you paid for the property. If they just waited and you inherited it, you get a step up. The basis goes up to the market value on the date of death. And so there's really not any income tax or estate and gift tax implications in gift or inheritance. It's the future capital gains aspects, depending on whether you got a carryover basis or a step-up basis. And why does a gift carry over basis, and why does inheritance step up? I don't know why that was done originally, other than the step up in basis in inheritance was just a tax break that was given. It doesn't make good tax policy. It doesn't make good common sense, but it's one of those tax games that if you play properly, you get by. And if you don't, you don't. And, I've had people not want to do this because they feel like, oh, this is something illegal, improper, unethical. No, it's part of the Internal Revenue Code. It's part of the 1031 regulations. You have not only the right to do this as an American, you can, it's tax avoidance, and it's all legal and it's all proper. My partner of mine years ago, tax attorney, I think I alluded to him before. He used to say the difference between tax avoidance and tax evasion is 6 years in the penitentiary. You want to stay on the side of tax avoidance,
Yes.
There's no reason that you can't do this. And exotic stuff like this sometimes scares people.
Yeah.
But it shouldn't. It is recognized as long as you stay inside the white lines.
I think it's that unknown.
Yeah.
It's that unassurance because, when you don't deal with it every day or you don't understand it.
Most lawyers don't. Most real estate agents don't deal with it often. Most investors don't deal with it. The average person, they're walking down the street. It looks kind of exotic, but it is actually very standard. There's an entire industry that revolves around it. It's controversial. In the last few years, there have been proposals to do away with 1031s completely. There has been a proposal to eliminate step-up in basis on inheritance for a decade now. None of the changes have ever passed. Matter of fact, they hardly ever get off the ground. And part of that's because most of the members of the House and Senate use this all the time themselves. So they're not going to do anything that's good.
Yeah.
No, that's how they're keeping their money.
Absolutely. And that's how they're passing it on to the next generation, utilizing that step up in basis.
Yeah.
You for capital gains purposes, you get to start all over again. As I said, you take your capital gains to the grave with you.
Wow.
But I've run into that. People do not need to feel queasy about it. They don't need to feel reluctant because they don't know anything about it. Utilize professionals like you guys and ask your CPA. Let me help bring an exchange company in. For a small amount of money, we can save somebody a ton if it's appropriate, and be prepared to accept the fact that maybe it's not the best thing.
Yeah.
But when it is, it's fantastic.
I definitely see it that is one of those you really have to make sure it's going to be the right direction before you take and pull the trigger on it.
Oh yeah. But when it is, it's fabulous.
Yeah, I was going to say at the same time though, it could be very beneficial.
Right.
So I could talk to you a million times, Randy, and I think I learned something different every time.
Well, my head's starting trying to understand it all.
I appreciate you saying that. Usually when I talk about things, this kind of thing, people's eyes glaze over, roll back in their head.
Oh, no.
Right before they pass out. But really,
that's how I'm feeling. You can't see me, but, that's how
I can't see you. So
I don't have any hair.
You roll back in your head. I can't see you.
Oh, Lord. No, I love it. And
I can still. I have a 4-hour version of this course I teach on 1031 exchanges. I can assure you, after 4 hours of this, my eyes will be rolling back in my head.
We've sat in that. Didn't we do that?
Yeah, they did it, Jonathan's. I remember that.
Yeah.
We did the short version.
Short version?
I've got an hour version, a 2-hour version, and I have a 4-hour version. Yeah, the 4-hour gets a little.
We've only had just an hour of
Yeah.
hearing some stuff, and my head hurts from it. So
well, and we were at a restaurant, so we had food, and if we needed to, we could drink. So
yeah.
Well, I just fixed to say I'm gonna have to go home and have me a good drink.
I didn't. I don't think anyone did, but it was available.
But what do we have in what is?
Well, we just had Mila and Donnie. I think said good show, very informative guys.
Good. Yeah.
So.
Good,
yeah,
good.
we're sorry you didn't get to see our
beautiful faces, but you got to see
that myself.
You got to see
Adam Crystal, thank you so much. Thank you.
Yeah, I mean, we had it working before we got on, so I don't know what.
Yeah.
But,
you'll figure it out later.
The sound was there, but we appreciate you so much, Randy, taking your time tonight. It's late, and thanks for the information, and we look forward to speaking again.
Thank you, guys.
Appreciate it. Have a good night. Be safe going home.
Yep. If anybody's looking to buy or sell or invest in real estate in 1031, give us a shout.
We can do it.
We'll do it. We'll get you connected with the right folks.
All right, Randy, you be safe.
All right. Good night.
Take care, Crystal. Bye-bye.
See you.